When I say investing, what is the first thing that pops into your head? If the answer is real estate or stocks, then as Master Yoda once said, we need to unlearn what you have learned. Investing is about how we're using our time, energy, and money to multiply our resources. While stocks and real estate are great investment vehicles, there's much better things that we can be doing to get a higher return on our investment when we're starting at zero. We have to rethink what investing really means to us, because sometimes what we are trying to do is just get the best bang for our dollar. Sometimes investing is not just about making more money, it's about losing less money. Where you should start investing is really unique based off of your financial footprint. It's going to be different for everyone depending on your situation and the goals and timelines that you have set for the investments. However, there is kind of a general framework that most people can follow with some really common investments. The first one is to pay off high interest debt. Things like credit cards or payday loans, anything like that. Paying that off first is going to be your best investment. I know that doesn't sound like an investment, but there is not a stock on this planet that you are going to be able to put your money in and consistently out earn 25 to 30% interest that's compounding every single month. So again, this isn't necessarily an investment to make more money. It's an investment to keep you from losing more money. The second thing that's really important to invest in is your financial foundation. And that is 6 to 12 months of your monthly expenses saved up. It's not wise to build a house on sand. That's why investing when you don't really have a lot of money saved up is incredibly risky, because if all of a sudden you need cash and you have to sell off those investments, well, if those investments are down, then you're gonna have to sell them at a loss, which is making your situation just that much worse. The 6 to 12 months of monthly expenses saved is our concrete foundation of which we are going to build our house on. This is an investment in our security and our stability that is going to allow us to take even bigger swings on investments down the road. One thing that people don't talk about a lot, but I can speak from experience, is that when you really hit that 6-month mark of monthly expenses saved, the anxiety and the pressure that you just feel kind of come off your shoulders, it just makes every day that much better. The next one is your employer's 401k. Now, this is incredibly rare because this is blanket advice across the board, applies to absolutely everyone. If your employer offers a match for your 401k, then you absolutely need to be putting in at least what they match up to. If they match 4%, then that means you put 4% in. The reason for that is you are getting 100% return on your money every single month, and you're getting it with a tax advantage. There's no other investment in the modern world that is going to be that consistent. So if your employer does a match, you need to make sure you're putting in at least as much as what they're going to match. And if you've done all of those things and you're like, look, I still want to go buy some stocks, that's the direction I want to go, I want to start building wealth in the market. Okay, well then check out some ETFs instead of individual stocks, because the majority of professionals who are picking stocks still don't beat the market over a 5-year mark. So chances are you're not going to either. So focus on some industries that you're really passionate about, that you like, and buy a bunch of stocks all together through an ETF. Now remember, investing is about putting your time, energy, and money into something in order to compound the resources that we're going to get later on in life. Because of that, there is one investment that consistently gets overlooked that every single person on this planet needs to be investing in, and that is you. So how exactly do you go about investing in yourself? Well, you do it by reading books around your skill set and the things that you're currently making money with. Okay, but Stephen, I hate reading. All right, great. Go listen to some podcasts. Well, Stephen, I hate listening to things. Well, okay, great. Go get a coach or talk to a trainer. Do whatever you have to do. But the point is, there's so many different ways nowadays for us to learn and get better at whatever our primary skill set is in order to make us more valuable out in the marketplace. There's just no excuses for it. And the crazy thing is, there has never been more free information out there in order for you to be taking advantage of. The podcasts, the YouTube videos, it's unbelievable what you can learn without ever having to pay a dime. So when it comes to investing in you, there's 3 things that I think every single person should be focused on. The first one is upskilling, which is where you go and you are doing trainings, you are getting coaching, you are reading books, you're doing whatever you need to do to get better at your primary skill set. So whatever it is that you have at your job that is helping you make money, do whatever you need to do to get better at it in order to make you more valuable to the marketplace and to be able to earn more money doing that. The most common indicator that millionaires have that started off at zero was that they continually increased their income over the years. It is the number one factor in determining whether somebody's going to reach $1 million net worth or not. So don't sleep on your job and try to go off and just immediately get a side hustle. There's nothing wrong with that, but a lot of times we forget that the fastest way to make more money is actually just to get better at what we're already making money doing. The second thing that everybody should be investing in is something called reskilling. Now, reskilling is learning new but complementary skills to your primary one. So a perfect example would be like what I'm doing right now. I know a lot about money. That was my primary skill set. I know how to talk about investing and different things like that. But to help me be better at it, what I learned was about lighting and about sound and video. And that enabled me to be able to create products in order to sell alongside my services. So while learning about video and lighting and sound didn't have anything to do with the financial industry, it complemented those skills and has enabled me to make more money as well. So that's something that you should figure out. If you're in sales, I encourage you to take listening courses and copywriting classes. If you're in construction and you know how to cut wood, well, then maybe you go and you learn how to actually do marketing and business, and then you can create your own company if you want to do that. So there's a lot of different examples and a lot of different ways that you can learn new things that will tie into your primary skill set and help you make even more money along your journey. And the third and final thing that I think every single person should be investing in is their financial knowledge, because it doesn't matter how much money you make or how much money you keep or how much money you invest. At the end of the day, the thing that's really going to make a difference is what money means to you in your life. Because if you become rich and you have more money than you could ever want in your life, that's great. But I know a lot of miserable rich people because they've never really thought to evaluate the things that they wanted the money for and what it's enabling them to get. So you don't want to end up somebody who just has a really fat bank account, but no friends or loved ones who care for them anymore because everything they did was just for that. So it's important that we understand not just how to make money and keep money and build that number in our bank account, but also what it means to us in our own personal lives and what we're utilizing it for. Again, as we're rethinking investing, we want to think beyond just earning 7% in the market when we're starting off at zero, because you can make very large percentage returns with small amounts of money. So we talked a little bit about this in the first part with mindset, but I want to go over it again because it's really important. Let's say you have $1,000 to invest. Well, if you put it into the market and you make 50% in a year on that, that is an insane return. Okay, that is absolutely fantastic. It would be in the top 1% of stock market returns probably for that year. But here's the thing, if you make 50% on $1,000, that's only $500. That's not that much money. That's why sometimes it's better to invest that $1,000 in other things that can get us 500%, 1,000%, or higher returns on that investment. So examples would be getting training or additional certifications on your existing skill set. I had a friend in project management who was told by his job that if he got this additional certification, they could give him a $10,000 raise. Well, it was a $500 test he had to pay for, and it took him 3 months to study for. But then he did it and passed, and at the end of it, he got a $10,000 raise. Just that year, that means his return on that $500 was 2,000%. And he's going to continue to make that as long as he's in this job. And it's going to set him up to earn even more money if he gets more promotions due to the fact that he has this. So that's a perfect example of what I'm talking about. Another thing you can do is take that $1,000 and focus on flipping items like furniture or power tools or even collectibles. A lot of times people will collect things like sneakers, or I like collecting Pokemon cards and basketball cards. And because I am so knowledgeable of those things, because it's a hobby of mine and it's something I get to do with my son and we have a lot of fun with it, we are able to make a little extra money on the side because I can see, oh, somebody's selling that card for $50. I know I can sell that online for $100. And you can make a little extra money doing that way. I also love really low entry weekend side hustles, doing things around your neighborhood, even like car detailing, garage organization, cleaning houses, mowing lawns. These are all great ways that you can earn anywhere from $50 to $1,000 a job. So again, let's go back to that. If we have $1,000, let's just say that we're going to do $300 for the initial equipment that we need in order to get going. Then on top of that, we're going to pay $100 to get a professional photo taken and a couple little graphics design, and we're going to set up a free Facebook page and a free LinkedIn page as well. Then after that, we're just going around telling people what it is that we're doing and trying to get a few jobs here and there. And then once we get some of those jobs and we do a great job for them and they're very happy with us, we just ask for referrals and say, hey, is there anybody else you know who you could recommend us to? And the great thing about these jobs is that you can do them in just a few hours every single weekend. So let's say that you only did 3 jobs every month and that you averaged about $250 a job. Well, if you were to do that, knowing that our investment was only $400 to get started, well, then that would equate to $9,000 a year, which would mean a 2,250% return on that $400 investment. You're not going to do anything like that in the stock market. This is why it's really important that we change our thinking about investing from just being stocks and real estate to how am I using my time, my energy, and my money in order to compound and build up my assets. Now, the last part of any investment strategy that we have to talk about is risk management. Understanding your risk level is incredibly important because it can change how much money you invest and where you're investing it. Now, this is speaking in general terms, but men tend to be much more high risk with their investments than women are. While sometimes that can pay off in the short run, when you look at returns over time, women actually tend to do better. While some guys will definitely have success with this strategy, over the long term, when you look at it, women on average tend to have better performing portfolios because they are less risk averse. Most of that just comes down to the fact that the majority of day traders are actually men, which is incredibly high risk, and most of them are not disciplined enough or have a system in order to beat the market. At the end of the day, with anything, you want some combination of a long-term strategy with short-term big swings that you're trying to take. So right here is a couple recommended portfolio breakdowns based off of your risk assessment. So if you're a high risk, medium risk, or low risk, something like this is going to be what you want to balance your portfolio out in order to get the best returns. So if you want to get into some markets, I recommend opening an account with a trading platform like Fidelity or E-Trade. All you have to do is put your banking info in, create an automatic transfer every single month for what you want to invest, and then find a fund and make it an automatically recurring monthly buy. Not ready for that yet and you're still putting money in your savings? That's great. Right now, with the way that interest rates are, you can get a HISA, which is a high yield savings account at almost any single bank and earn anywhere from 3 to 5%. Google it, find a bank that has some decent interest rates, fill out the information and get signed up, and it'll probably take you 10 minutes. Congrats, you're officially your own wealth advisor.